We treat modern money like an immortal string of code. With a tap on your phone, you can send value across the planet in seconds, operating on the assumption that digital mobility is a permanent feature of your bank account. But in a systemic crisis, geography suddenly matters again. Governments can flip a switch and replace those open digital networks with hard, impassable policy borders, instantly halting that digital mobility. This is capital controls, a series of deliberate, systemic mechanisms that states use to legally trap private wealth inside their own borders. For anyone caught inside, the realization hits hard. The numbers sitting on your screen look identical to yesterday, but they are no longer entirely yours to command. These invisible policies function as a final gate, pinning assets within a jurisdiction, regardless of where the owner intends for them to go. A financial lockdown rarely happens overnight. You don't wake up to a sudden announcement that your money is frozen. Instead, it begins with a subtle, systemic friction. The process usually begins with a shift in how foreign exchange flows through the system. You will notice banks delaying your international payments. What starts as a temporary administrative backlog often grows into a reality where importers simply cannot source foreign currency. This graph plots the official government exchange rate against the street rate. Under strain, a persistent gap emerges as the street rate climbs. This widening gap applies immense pressure on policymakers. The larger the spread gets, the harder the government intervenes to stop capital flight. This pressure eventually leads to a demand for justifications. Routine transfers for tuition or medical bills suddenly require deep stacks of paperwork and explicit government permission. These new hurdles are not administrative errors. It is deliberate friction designed to quietly bleed the momentum out of capital flight before the state applies more absolute measures. To understand why a government resorts to these measures, you have to look at the crisis from the perspective of a state treasury dashboard. The first threat is defending a collapsing currency. To prop up that central pillar, the bank drains its foreign reserves. Then citizen panic hits. Millions attempt to pull resources out simultaneously, causing the structure to buckle under massive bank runs. Facing total collapse, the state views freezing civilian assets strictly as emergency triage. It is the most effective way to keep the broader domestic economy functioning. It is a matter of strict mathematics, not malice. When forced to choose, a state will prioritize its own macro survival over the micro-financial freedom of its citizens. As the crisis deepens, the state moves beyond the friction of paperwork and toward absolute barriers. This marks the transition to hard limits. Daily withdrawal caps and strict ceilings on international transfers appear overnight, introduced as temporary measures. Over time, these withdrawal caps often lose their temporary status, eventually becoming a permanent, unmovable fixture of everyday banking. In the final stage, the state requires forced conversion. Citizens and exporters are legally pushed through a funnel, forced to surrender foreign currency for local money. Because this happens on devalued official terms, the money instantly loses a significant portion of its purchasing power. By this point, the illusion of private ownership is gone. The financial trap has fully closed, and private wealth now functions as state property. When the dust settles on a financial lockdown, the outcomes for the state and the saver look very different. The state secures exactly what it needs. By freezing assets, the government captures the trapped liquidity required to avoid immediate systemic collapse. The everyday saver absorbs the impact. Left holding trapped, rapidly depreciating local currency, their purchasing power turns to dust. They can no longer move or protect their value. You cannot stop macroeconomic capital controls from happening, but by watching this progression, from exchange rate gaps to paperwork requirements, you can identify the risk early and act before the final lock clicks. True financial literacy means understanding a difficult reality. In a systemic crisis, your money is only yours until the government needs it more. Keep this educational framework in mind to spot risk early. And remember, this is not financial advice, just preparation.